Thanks so much for joining into today's Talking Point. I'm your host, Nilesh Shah. Our guest today is Mr. Nilesh Shah of Kotak Mahindra AMC. And in amongst the conversation points that I thought we should quiz him today on would be one, whether the latest economic data and the inflation data makes the case for equities that much weaker. Would rate sensitives continue to remain under pressure for the better part of 2023? Would chemicals and pharmaceuticals continue to have a longer winter? Maybe he has a view there. We'll try and ask him on that. And we'll, of course, try and ask him about what does he see the global asset allocation to be like in a scenario like this in a disjointed world. Mr. Shah, good having you. Thanks so much for joining in. It's a pleasure talking to you always.
Thank you, Neeraj, for inviting me over here.
No, the pleasure is ours. Just wanted to start off by asking you, how do you see the global macros impacting all asset classes? Simply because the trial balloon of peak rates and then a cut for now seems to have been punctured.
So we believe globally central bankers will be walking left and talking right. They are acting like that proverbial joke where 4 people came out of the motor car which had shut down, and 2 people were from pushing behind, and 2 people were pushing from the front. On one side, central bankers have raised interest rates led by US Fed. Even Bank of Japan has moved a little bit. But at the same time, none of them are withdrawing liquidity at which they need to withdraw to control inflation. Fed, after adding more than $4.5 trillion of liquidity, has taken out about $500 billion of liquidity, keeping system surplus by more than $4 trillion from 2008 subprime crisis till COVID crisis. All the developed nations' central bank balance sheet, which had started coming down, has now started stagnating. We really don't know how this will end. In terms of commentary, we believe central bankers will push for rates higher and longer. But with the massive debt burden which their country, their government, and their citizens are having, will they be able to follow up on that warning? That remains doubtful. The market continues to play kabaddi match with US Fed. They are inverting the yield curve. The 10-year, the 30-year is lower than the 2-year. So how this entire game will play through, one really doesn't know. I just hope and pray that central bankers are like typical Hindi movie hero. They take the car to the cliff at high speed and then they make a sharp U-turn. Let's hope and pray the central bankers don't crash the global car and will make sharp U-turn so that the debt burden does not end up crushing economies.
Okay. So if it is that uncertain, how do you anticipate the scene in India could be if both of the things happen, which is that the macro data doesn't quite live up to the buoyant hopes and shows some chinks in the armor, but there is also the issue of the currency or the interest rate differentials that Indian central
Hi, I'm not able to hear Neeraj Bhai.
Can you hear me, Nilesh bhai?
Yes, now I can hear you.
Okay, sorry, I don't know how it went through. But nevertheless, what I was asking you was, how do you foresee the Indian central bank's actions in this regard of uncertainty that you spoke about? And what is the impact on risk assets like equities in such a scenario?
So clearly, the Reserve Bank of India has so far managed inflation reasonably well. Throughout calendar year 2022, inflation remain above RBI's target range. But for the first time in our history, Indian inflation was lower than American inflation for almost 16 months. CY23, FY24, average inflation will be within RBI's target range, albeit at the higher end and not at the lower or middle end. From inflation point of view, RBI has some amount of cushion. However, RBI is not just managing inflation. They have to take care of growth. They have to also manage currency. They also have to manage government's borrowing program. My feeling is that RBI will be data dependent. They will continue to move depending upon how the data comes. If inflation gives them respite, they'll focus on growth. If currency needs to be taken care, they'll probably focus over there. And if our government borrowing program requires RBI's intervention, which is most likely to be the case in FY24, they'll intervene there. They'll continue to juggle multiple balls to ensure that inflation remains under control, currency remains near its fair value and stable, government's borrowing program passes through without much disruption, and Indian growth continues to get supported. It's a tall task, but then if RBI is betting like Surya Kumar Yadav, why shouldn't I expect them to score at 150% strike rate and hitting fours and sixes at will?
Okay, so despite the difficulties, you reckon that much of these issues that you spoke about would be manageable in 2023?
Undoubtedly. But Neeraj bhai, it's not that we are sitting on bed of roses. There are some thoughts, there are some chinks in our armor. The first and the most important is slowdown in consumption. For almost 9 months in a row, we are seeing negative volume growth for listed FMCG companies. Rural has been negative consistently. Urban is going up as well as down. Clearly, bottom of the pyramid in terms of consumption is slowing down. Now, is it impact of inflation? Is it impact of COVID? Is it impact of repairing of balance sheet because they would have survived COVID by borrowing money, by pledging their jewelry and assets? Or is it the rise of unorganized sector, which is taking away market share from organized sector? I really don't know, but clearly there is a cause of concern on the consumption at the bottom end. The second worry for us remains energy prices. Today, energy prices are in 2 digits. We are in a better shape. Tomorrow, energy prices goes in 3 digits. We will be under pressure. The third thing is our current account deficit. Except for last month, for almost a year before, we were running trade deficit and balance of payment, which was way beyond our comfort. Fortunately, in the month of Jan, there is a ray of hope where sharp drop in imports and surge in services exports has narrowed down trade deficit well below our manageable level. I think India is in a great position. It's an oasis in the global desert. But if there is a sandstorm blowing out in the desert, some sand will get deposited into our oasis. If we can manage the chinks in our armor, which is consumption at the bottom end, which is energy prices, and which is the trade deficit, then once the sandstorm blows over, we'll be in a far better shape.
In which case, what about equities? After 18 odd months of near flatline performance, the recent investors not seen cycles might have been hoping that there will be some bit of an uptick, but it seems to be a difficult year for world equities by and large. You reckon it could be yet another year of near flatline performance?
We believe, Neeraj bhai, equities will be driven by events. There is Russia, Ukraine, energy prices, and US Fed pivot. which will continue to impact our market. There is corporate results, which in September and December 22 quarters were little below expectations. There is RBI's pivot. And finally, we have May 24 general election. With all these events lined up, it's difficult to take a call whether markets will go up, down, or remain stable. The fair value of the market is somewhere around current level based on our historical averages. Maybe we are at a marginal premium, but somewhere around historical averages. But it is the other markets which have fallen down below their historical averages, and that has made look India expensive. Clearly, active fund managers on the foreign portfolio side are selling India to buy cheaper markets like South Korea, Taiwan, China. In this growth versus valuation paradox, long-term investors will buy India on correction as valuation becomes reasonable. The tactical short-term investors will book profit from India because it looks expensive vis-a-vis peer group. My feeling is that from here till May 24, we are a buy on dips market. We are a market where it may not be worth leveraging at this level, not even having overweight to equity at this level. Keep some dry powder ready and use it wisely whenever correction occurs. If events turn positive, markets can deliver better return. If events turn negative, markets will deliver negative return.
Got it. One final question, and that would be on what could drive the markets post that. So I heard you say that it will be an events-driven period till May 2024, assuming that the election verdict in May 2024 is something that the market likes as well, Mr. Shah. And if the markets have not done too much until then it's nearly 30 odd months of flatline performance while earnings would have compounded hopefully and reached that 1,000 mark for the Nifty. Do you think at those levels the markets become very attractive, or would it also be dependent on what the world events are at that point of time?
Now, Neeraj bhai, while we will be driven over longer period of time based on our fundamentals, we can't wish away how the world operates. Now, if rest of the world continues to trade at 1/3 and 1/2 India valuation, then it doesn't matter what we are doing. There will be always tactical short-term plays where people will go to cheaper markets. I think India has to focus on three things. The 3G growth. Our earnings growth should be such that even though we may look expensive on a one-year basis vis-a-vis cheaper markets, we remain attractively priced on a 5-year basis or a longer-term basis. I must ensure that my earnings growth is such that while short-term players may think I am expensive, long-term investors will believe I am still cheaper on a longer-term basis. The second thing is governance. Today, in China, the top technology banker has gone missing. In Russia, people who criticize governments fell down from hospital window and died, no matter whether they were chairman of the largest private sector oil company. Compared to them, our governance standards are far, far superior. We must maintain that lead. And the third G is green. There are very few emerging market countries which is taking responsibility of environment. Not only India attended and committed in COP26, it is also taking several steps on renewable energy. One of the largest petrochemical company in India is talking about net zero carbon by 2035. This combination of 3G, green, growth, and governance put together will make India case a very, very compelling case to invest.
Well, let's hope it stays that way and improves even further. Mr. Nilesh Shah, such a pleasure talking to you. Thank you for taking the time out and being with us today on Talking Point.
Thank you.
And viewers, thanks for tuning into this leg of the Talking Point show.